BOSS. What is BOSS all about? BOSS is one of the very few questions that you have, which is very important though, that we ask the liability and equity section of the statement of financial position. Now guys, should we ask that? You should know yourself that you have to complete the statement of changes in equity first before you can complete the statement of financial position. Because you need the closing balances from the statement of changes in equity in order to compile the statement of financial position. So BOSS Security was incorporated in 2004 and has a 30 September year end. BOSS's main income is generated through the selling of security systems to households and businesses. They have a division that installs the systems and offers technical support, and a division responsible for armed responses. BOSS currently has branches in 12 major cities across the country. Over the past few years, BOSS has been receiving requests from potential clients in other cities to install their security systems and realize that they need to expand their operations. In order to facilitate the expansion, the entity will have a huge cash outflow, and it was decided during the 2017 financial year that they will concentrate on raising the required funds and commence with the expansion to other cities in 2018. The following information is available, and they start then with authorized share capital. Then they give us issued share capital. So authorized 6 million ordinary shares at a par value of R2.50 each. 1 million 10% cumulative compulsory redeemable pref shares at a par value of R3 each. And 2 million 12% non-cumulative compulsory convertible pref shares at a par value of R2.25 each. The 10% redeemable pref shares are compulsory at the redemption date, and the 12% convertible pref shares is compulsory convertible to ordinary shares. Issued share capital. During 2004, many months ago, the following shares were issued. No further share issues were made until the current year. So obviously here, this is our opening balances in our statement of financial position, or in our statement of changes in equity. 2.4 million ordinary shares issued at R2.80 a share. Guys, it was R2.50 ordinary shares. So what would the capital amount have been? That would have been 2.4 million multiplied by R2.50, which gives us 6 million rand. And the share premium would have been 2.4 million shares multiplied by 30 cents a share, and that would have equaled 720,000 rand. Okay, let's just 500,000 of the 10% compulsory convert to, let's do that, let's just do this. So in our ordinary share capital account, opening balance, only the 6 million rand, the par value shares. In the share premium, because there's more than one class of share that was issued at a premium, we will park in the meantime the 2.4 million at 30 cents, i.e. 720,000. So just park it there. Right. 500,000 of the 10% compulsory cumulative redeemable pref shares were issued at par. The shares are redeemable in 2019. So we are now 2017, I think, if I remember correctly. So what was the par value? 3 million rand. So 500,000 times 3 million rand was what? It was the balance of the redeemable pref share loan account, 1.5 million, not part of the statement of changes in equity. And then 600,000 of the 12% convertible pref shares were issued at R2.75 per share, the par value being R2.25 per share. So here we would have had capital 600,000 multiplied by R2.25 equals 1,350,000, and premium would have been 600,000 shares multiplied by 50 cents a share, which gives us then 300,000. So going back to your statement of changes in equity, you would have had 12% convertible pref shares 1350, and then the 600,000 times 50 cents would have been added to the ordinary share premium, because I always only have, very important, one share premium column in my statement of changes in equity. It doesn't matter whether it actually consists out of two components, but I only have one column. And the total of the share premium then 1,020,000. Good. Share transactions during the current financial year. So that is what we have to record. On 1 April 2017, a special resolution was passed to convert all ordinary shares in issue to no par value ordinary shares. So let's do that first. So we have to convert the par value shares in no par value shares. How are we going to do that? We're going to take the capital out of the capital account and transfer that to a declared ordinary share capital account. And we're going to take the ordinary shares premium, which equals the 2.4 million at 30 cents. That's 720,000 out of the share premium account, and we're going to transfer that to the declared ordinary share capital account. So in total, we're going to transfer 6,720,000. Now we're ready to issue new shares. On the same date, an additional 2 million shares were issued at R3.50 per share. Share issue costs amounted to 160,000, and BOS adopted the policy to close off the share issue costs against retained earnings. So fresh capital, 2 million at R3.50 plus 160,000 share issue costs against retained earnings. 2 million at R3.50, 7 million, and share issue costs against retained earnings, 160,000 rand. On 1 June 2017, it was decided that 40% of the 12% convertible pref shares should be converted into ordinary shares at a conversion price of R3.75 per share. So it's important to note here that those convertible pref shares has not been converted into no par value shares. There's no fresh issue of convertible pref shares at this stage. So it is not necessary to first convert into no par value shares and then to convert into ordinary shares. So I can convert as is from my convertible par value share capital account 40%, but I must remember that I must also convert 40% of the share premium that belongs to this convertible pref shares to my ordinary share capital account as well. So what are we going to take out? Out of our 12% convertible shares, we're going to take out of that opening balance of 1,350, 40%, and that equals 540,000 rand. The share premium attached to the convertible pref shares was this 300,000, the 600,000 at 50 cents. So I'm also going to convert 40% of that 300,000 into ordinary shares, and that equals 120,000. So remember, a share conversion from one type of capital into another type of capital is merely only a move of equity. So I'm going to move the 540,000 out of the capital account. I'm going to move it means I'm going to debit those accounts. I'm going to debit the share premium account, and I'm going to credit the declared capital, ordinary capital account, with the sum total of those two, 660,000. They tell us that we're going to issue those shares at R3.75 per share. It is a conversion price of R3.75 a share. So how many ordinary shares are we going to issue? Well, we're going to take the 660,000 divided by R3.75, and that's going to give us 176,000 ordinary shares. What is important though is the date. Let's just put the date here. And that was on 1 June. Why is it so important, guys? Because for dividend calculation purposes, I need to know when the conversion took place. Property, plant and equipment. On 31 May 2017, BOS purchased 5 plots of land in various cities throughout the country. BOS received a report from S. Smith, a sworn appraiser, who was requested to do a valuation of the existing land owned by BOS. The property was bought in prior financial years. Mr. Smith estimated that the fair value of the land was 7 million rand. The land was originally purchased at a cost of 4.8 million rand. It is the policy of BOS to reflect the land at revalued amounts, but this is the first time that BOS is going to revalue the land. So therefore, what is going to be our revaluation surplus? It's going to be the difference between the actual value 7 million and the cost of 4.8 million. And that gives us a total revaluation of 2.2 million rand for the first time. So therefore, we're going to have other comprehensive income in our income statement of 2.2 million, and we're going to have a revaluation reserve increase in our statement of changes in equity, revaluation reserve 2.2 million, which will give us then a closing balance of the revaluation reserve of 2.2 million at the end of the year. Good. Loan. On 1 October 2016, that is the beginning of the current financial year, if I'm not mistaken, a loan of 3.2 million rand with an annual interest rate of 11% per annum and a repayment period of 20 years was received from Corporal Bank. The loan is repayable in annual installments of 401,842, inclusive of capital and interest, just to check whether you still remember how to do that. The first repayment was made on 30 September 2017, that is year end. No entries have been made to account for the payment in the current financial year. So we have to go and do the amortization table. Outstanding loan amount in the beginning of the year, 3.2 million. Interest rate, 11%, installments, 401,842. Which I now have to split into interest and capital, and also I have to do that for next year. I have to do the statement of financial positions, equity section, liability section as well. So I have to know which portion was long term and which portion was short term. So let's go and let me see where I've done the calculation. Yeah. In the beginning of the year, 3.2 million rand outstanding loan. Our interest was 11% of the 3.2 million, which gives us 352,000. Now that interest needs to be adjusted and work. I need to post that entry and I have to adjust my profit before tax for that. If my installment was 401,842, my interest portion was 352,000. It means the difference was my capital repayment of 49,842. That's 1.5, 1.5, that's the mark allocation. So what is going to be my outstanding loan amount at the end of the year? It's going to be the 3.2 million less the 49,842, which is 315,0158. How much is going to be my interest next year? 315,0158 multiplied by 11. And that is going to be 346,517. So I'm just going to write here, it is 3.2 million less 49,842, which equals that amount, times 11%, 346,517. So that means our capital repayment next year will be the difference between our installment, 401,842, and the interest, 346,517, which gives us then capital repayment of 55,325. And this is our short-term portion of the long-term loan. The long-term portion of the long-term loan is going to be the 3150 less the 55,325, which is going to be this amount, 3094,833. So if you go to your statement of financial position, where you can write down your skeleton in the meantime, BOS Security Limited statement of financial position as of 30 September 2017, 2017 Rand, liabilities, non-current liabilities, bank loan, and there it is, 3094,833, which equals that 3094,833. And then under current liabilities, Short-term portion of long-term loan, 55,325, and there it is, 55,325. Dividends. On 31 March 2017, an interim dividend was declared and paid on all shares, and the dividend per ordinary share amounted to 20 cents per share. So on 31 March, when did we actually do new share transactions? On 1 April. So that means that that dividend was declared and paid based on the 2.4 million opening balance dividends. So I'm going to show it in this calculation for us. Dividend. The interim dividend was 2.4 million at 20 cents a dividend, which equals 480,000 rand. Now, what was the dividend on the convertible pref shares at that point of time? Well, the convertible pref shares at that point of time was this original amount, 600,000 times 2.75 rand was the issued. Our capital amount was 1,350,000. At that stage, the conversion into no par value, well, there is at this stage also no conversion into no. Very important, the dividend is calculated only on the par value of the shares of 1,350,000 times 12% for 6 months up to the dividend declaration, which gave us 81,000, and that dividend was also paid. Why am I interested in the paid portion? Because I have to draft a statement of financial position as at year end. And at year end, if there was any dividends outstanding, I should show that as shareholders for dividends at year end. Then, a final dividend of 40 cents per ordinary share was declared on 1 September 2017 and payable on 15 October 2017. Do we have to account for it in this year? Yes, we do. It was declared in the current financial years. To whom are they going to pay that? All shareholders that was registered in the share register on the 30th of September 2017. All shareholders are natural persons. Important for dividend, withholding tax. Good. Now let's first determine what is this dividend going to be? How much is it going to be? Now if we go back to our statement of changes in equity, we had 2.4 million shares initially. We issued another 2 million shares at R3.50, and we have converted 176,000 shares. There it is, 176,000 shares. So we have in issue 2.4, 4.4, 2,576,000 shares. Where is that? Oh dear, yeah, sorry. 2.4, 2,170,000. I can't add, it's 4,576,000 shares. Multiplied at 40 cents per share, so that then gives you a declared ordinary dividend of 1,830,400. My convertible pref shares, well, we said we've made this conversion on 1 June. So it was an outstanding capital amount of 1,350,000 multiplied by 12% up to the interim dividend phase, and then thereafter the outstanding capital amount was 810,000 multiplied by 12% for the second part of the year. So 810,000 multiplied by 12% multiplied by 4 months, which gives us 32,400. And then for the rest of the portion, that was only the 1st of June. When was the interim dividend declared? The interim dividend was 31 March. So it is March, April, May. April, May, it was on the 1st of June, so it's 2 months. The 1st of June, we have done that conversion. The 1st of June, so it's 2 months. So it is still on 1350 times 2 months, and then on 810,000 for the remainder of the year, which is from the 1st of June up to the end of the year. So that equals then 4 months, 32,400. Just write here for ourselves. We say, as from the dividend declaration date, which was 31 March. So 31 March, which is 1 April then. 1 April to 1 June equals 2 months. And then here it is 1 June to 30 September. So it's June, July, August, September, which equals 4 months. And that gives us that 32,400 Rand, which gives us in 49,400. So the total dividend, which was declared and paid during the year, 480,000, 1,830,400, 81,000, and 59,400, in total 2,450,800, which will be the dividend portion year against retained earnings, 2,450,800. For statement of financial position purposes, I have to see that this one was declared and that one was declared. So our shareholders for dividends will be those two together. But remember, we have to split it out in order to determine what is shareholders for dividends and what is SARS withholding tax. So shareholders for dividends would be then our final dividend of 1,830,400 plus the 59,400 multiplied by 80%, because all our shareholders are natural persons, which gives us 1,511,840. The SARS dividend withholding tax would be 20% of that amount, the 1,830,400 plus the 59,400, which gives us 377,960. Don't forget, though, that we have redeemable pref shares, which is interest, but some of it has been declared, so it has been paid, and some of that dividend is still payable at year end. So the 1.5 million redeemable pref shares, if we go back here, equals the amount which was initially issued, 500,000 times 3, 1.5 million, multiplied by 10%. The interim dividend was paid halfway through the year, so therefore 6 months that has already been paid, and the final dividend needs to be paid now, 75,000, which is now declared. Now, shareholders for dividends then is that total amount of 150,000 will be have to be shown as interest in the income statement, which we will come to now. But our shareholders for dividends will then be the 1,511,840 plus the 75,000, which equals a total of 1,586,840. So on a statement of financial position under current liabilities, you're going to have shareholders for dividends, 1,586,840, and dividend withholding tax of 377,960, which is still that 377,960. Good, now you can tell me, yeah, but wait a minute, there was a special resolution on the 20th of September, whereby they decided that 70% of the dividend related to the ordinary shares, which will be settled by ways of a capitalization issue. Yes, that is true, guys, but what is even more important is this part. This transaction will be finalized on the 31st of October. So the 31st of October is in the new financial year. So therefore, as at 30 September 2017, what do I have? I have actually shareholders for dividends as a creditor in my books, as we have indicated here, to that value. So this fact that a portion of that is going to be settled in the new financial year by ways of a capitalization issue is not something that I'm going to record now, because the transaction has not yet been completed. Investment during 2015, BOS invested in 70,000 ordinary shares in Ceto Limited at R9.75 per share. Ceto declared a dividend of R92,000 at the end of September, which will be payable in October. Are we entitled on the dividend? Yes, we are in the current financial year because they've made a dividend declaration in the current financial year. We haven't passed any entries yet. Now tax, the current income tax rate is 28%, dividend withholding tax 20%, provisional tax payments were made during the course of the year. And then they tell us the opening balance for retained earnings was 4,735,000. So if we go back here, retained earnings 4,735,000. They tell us that 1 October, the South African Revenue Services owed BOS an amount of 54,000 Rand due to an overpayment of income tax of the previous financial year. Now, because we have to do the statement of financial position, I would strongly recommend that you draft a SARS income tax account. They tell us that the opening balance was that the receiver of revenue owed BOS 54,000 Rand. They also gave you the provisional tax payments already, so we can actually insert the provisional tax payment in that account of 980,000 Rand and 1,030,000 Rand. So bank was credited and SARS account was debited. We still have to work out our tax for the year. So then, once we've done that, we can determine what profit after tax was and we can determine what the outstanding balance on the SARS account was. Trade creditors had a closing balance of 129,000 as at 30 September 2017. So in our statement of financial position, trade and other creditors, 129,000 Rand. Profit before tax for the 2017 financial year, before any of these adjustments was taken into account, was 7,950,000. So let's quickly adjust our profit before tax. So we're obviously going to start with that amount of 7,950,000. We still have to account for the interest on the redeemable pref shares, and we have to account still for the interest on the loan. That one we've done. So that looks like the only two transactions that we still have to adjust our profit before tax figure with. So profit before tax, 7,950,000. Interest on the redeemable pref shares, we have calculated that as 150,000. And remember, that is a full interest amount. That is our total expense for the year, 150,000 Rand. Let's tell each other that there, by the way. Expense for the year, 150,000 Rand. Then the interest on the loan. The interest on the loan we've already calculated somewhere. Yeah. Interest on the loan, there it was. 352,000 Rand for the current financial period. And dividends we have received of 92,000 Rand. This was this very last one here somewhere where they've told us that we have received 92,000 Rand. Where was that? Opening balance. Under investment, during the year we have received 92,000 Rand worth of dividend income. So our total tax income, profit before tax, 7,540,000. Then we park it. Now we're going to do our tax calculation. Where do we start our tax calculation? With our profit before tax, 7,540. The only thing that's included in this profit calculation is dividend income, which is not subject to income tax. So we're going to take that out of our profit before tax in order to derive at our taxable income figure. We're going to get taxable income, 7,448. We're going to tax it at 28%. So our tax expense for the year, 208,440. We debit our expense account, 208,440, and we're going to credit SARS income tax, 208,440. Expense debit, SARS account credit. We owe that to SARS. That's our total commitment for the year. Now we have our profit after tax of 5454560, and now we can go and put that in a statement of changes in equity. 5454560, there that one is. And we can actually also determine what is our closing balance on our sales account. Now, when we balance off this account, we see that we end up with a balance there of 21,440, and that 21,440 is going to be a credit balance brought down, 21,440. So part of our liabilities, current liabilities, source income tax, 21,440. We have spoken about the short-term portion and the long-term portion of the loan. The other one that we haven't accounted for is our 10% redeemable pref shares, which is 1.5 million rand. That was nothing happened to that this current financial period, only the dividends that we had to provide on that. That was the initial 1.5 million, that 1.5 million on the redeemable pref shares. Now we can finish off our statement of changes in equity, and then we can just complete our statement of financial position. So our statement of changes in equity, we will have a declared ordinary share capital, 14,380. In our statement of financial position, share capital, here they've added the two together. I would strongly recommend that you show that separately. So it would have been what they've showed is a 14,380 and the 810,000 together. I would say you should show that separately. Then share premium, that will still be the remaining balance on the share premium account, which is 180,000. Revaluation reserve 2.2 million, and final retained earnings 7578760. Total equity then 21,148. That we've done, that we've done, that we've done all of it by now.